Here now to discuss a view is our of the banks and more is Stephanie Link. Stephanie, glad you could join us today. Great to have you with us.
Thanks for having me.
So, is the Fed to blame for this because they made money too cheap for too long, and then lots of banks got caught holding long-term mortgage-backed and Treasury securities that turned out not to be worth what they thought they were going to be?
Yeah, I think a lot of it is the Fed's fault in terms of the speed of the rate hikes that you talked about. But, Tyler, if you step back at the three failed banks, there are kind of company-specific issues going on, right? I mean, if you look at Credit Suisse, we have all known for 15 years that company and that bank was in trouble because the regulators overseas didn't really regulate, and the capital levels were so much different than that of the U.S., right? So Credit Suisse has always been kind of a problem, and it has been for a long time. On Silicon Valley, it was a concentration issue, right? A mix issue. 62% of their deposits were venture capital, and that's really risky. In addition, they didn't have a risk officer, which is incredible to me. And then, of course, they had a mismatch on their bond portfolio, and that is directly tied to the Fed and them raising rates quite quickly. And then finally, Signature Bank, it was really crypto, and they got into crypto in the kind of the ninth inning, if you will. And so that's not that surprising. Now, I'm not going to say that there's not going to be more and the contagion cannot happen. It certainly could happen. We're all watching First Republic to see how that whole thing happens. But I do think that the SIFI banks, the systemically important banks, the large banks, are very well capitalized. They have almost excess of $400 billion in excess capital. And I think they're gaining share, unfortunately, from the regional banks.
Do you think people understand that when they put money in the bank, it's really not there?
I think it's very confusing, for sure. The bank sector is a challenging sector to follow as an analyst and a portfolio manager, and I've been doing it for 30 years. It takes a long time to understand, and certainly people that put their money in maybe not are as familiar with how the whole thing works, how the plumbing works, if you will. But as I mentioned, I mean, the large cap banks, they're very well capitalized, they're very diversified, and they're very technology savvy, by the way, as well. And so I think that's, if you're going to look for an opportunity in terms of investing, I would absolutely encourage that part of the bank sector. Or, by the way, some of the preferreds in the large banks are really attractive in terms of the yields that you're getting. Yeah. So if you look at PNC and you look at PNC, you look at Wells Fargo, it's like 6-7%.
Right, but is that now in question, Stephanie, after what happened with the additional Tier 1 bonds and COCOs, whatever you want to call it? I mean, now people are going, well, wait a minute. If the capital structure isn't what we thought it was, would preferreds potentially be next?
Well, I don't think preferreds are going to be next. I think, if anything, the common equities probably will lag, but I think the preferreds are fine, at least to the large banks. That's why I talk about the excess capital, Kel, because that's so important. That's so much different than the regional banks and what their excess capital was.
Right.